Welcome to the latest video from Economic Perspectives. I'm Peter Warburton, Director of Economic Perspectives, and I want to talk today about what's driving global bond yields. Obviously it's been a bit of a roller coaster ride over the last couple of years. Apart from Japan, which has had almost sort of rock solid bond yields through the summer, but the escalation of US and European bond yields from May through June, July, took a lot of people by surprise, and yields have remained elevated since that time. Some people think of a 3% US 10-year bond yield as a kind of a limit, a line in the sand, if you will, but I don't see it that way, and I want to just explain in a few moments really what I think is going on. The big argument that has raged really, I suppose, since 2005 when Fed wasn't chairman then, he was governor, Ben Bernanke, raised the flag for the global saving glut. This notion there was a structural excess of savings in the global economy due to the repressed consumption in China and the revaluation of oil and commodity earnings in countries with relatively small populations and therefore unable to absorb them. And so the idea developed that somehow it was the savers that were to blame for the financial crisis in the end, because if they hadn't saved so much, interest rates wouldn't have fallen so much, and those savings wouldn't have been put to such abominable use in the US subprime mortgage market. Never bought into that. There's always been another strand of explanation here, which is really around financial variables, and some very clear work was done, I think, by Borio and others in the late 2000s and early 2010s to talk about how important the gross flows were rather than just the net. If you concentrate only on real saving flows, the corresponding variable really is the current account surplus, which translates into a surplus flow of capital. If you only concentrate on the net flows, then you're missing something, because actually the contributors really to US financial excesses were primarily European banks and insurance companies that levered up and bought the most precarious of those instruments, not the Chinese, who had the excess structural savings. So how does this work? Well, the more leverage there is in the financial system, then clearly the greater buying power there is in the bond market. And as extremes of bank leverage and more recently fund leverage have developed, then this facilitates the plunge in global government bond yields. And they reached their lows in the early summer of 2012, and since then they've begun a journey in the opposite direction. The big question for me is, have central banks played a key role in emboldening this increase in leverage? So we could say, well, the bank leverage phenomenon that was blown out by the financial crisis, but it's been replaced by, if you like, a secondary mechanism, which is the increased leverage really in the fund management industry. So we're in a situation now where the Federal Reserve has given us lots of different iterations of its monetary policy, lots of different parameters to concentrate on in interpreting what its future policy actions will be. But it seems to me that the more information that's been provided, and clearly the longer the time horizon over which the policy has been kind of underwritten or guaranteed by pre-commitment, then the greater the emboldenment of leverage. But this works in a great way if you're trying to lower interest rates by emboldening leverage. Then you have an amplified effect in lowering interest rates. But the problem comes when you want to send a message, as the Fed sought to do around May, June of this year, that actually there would come a time when it would want to shave or taper its asset purchases. And the mere whisper of that was relayed to the market as a much more violent change of policy, implying an earlier profile for interest rates to rise in America and elsewhere. And there was a violent bond market reaction, which we mentioned earlier, taking the US 10-year yield from around 1.5% to 2.5% very quickly, and peaking at close to 3% in late summer. So the message of this analysis is very clear, that if central banks have indeed played a key role in emboldening leverage in the financial sector, as it has applied to the bond market, then it should fear the consequences of any tightening actions that it takes. The rebound in bond yields this year was not a fluke, in my view. I think it will be replicated whenever the Fed takes away some of its key stimulus elements. And what this means is that really the urgency of bringing government deficits under control is much greater than it appears. The consensus would suggest that governments have 2, 3 or more years to bring their structural budget deficits back within normal range. I would suggest that the potential for debt service costs to enter a kind of upward spiral, which no amount of official purchases could correct, that scenario is much closer at hand than is commonly believed. Thank you.